The quarterly tax calendar every creator needs, so April never ambushes you. Waiting until tax season to think about taxes is how creators end up owing penalties on top of what they already owed. The first time a payout lands in your account with nobody withholding a dime for taxes, it feels like a raise. It isn't. It's your full gross revenue, untouched, with the tax bill quietly compounding in the background until one day in spring it shows up all at once. Plus, if you weren't paying along the way, a penalty for not paying sooner. This is the part of self-employment nobody puts in the highlight reel. The money you make selling ebooks, courses, coaching calls, and memberships doesn't come pre-taxed like a paycheck did. You are your own payroll department now, and payroll departments don't wait until April to do their job. Why creators get hit harder than employees? When you had a job, taxes were invisible. Your employer withheld income tax, Social Security, and Medicare from every paycheck. So by April, you were usually just confirming the math. Self-employment removes that middleman entirely. As a creator running your own storefront, you're responsible for both halves of Social Security and Medicare, commonly called self-employment tax, currently around 3% combined, on top of ordinary income tax on your profit. That's why a creator earning what looks like a comfortable full-time income can still be shocked by a tax bill an employee earning the same amount would never see, because the employee's version was already deducted bi-weekly without them noticing. Because there's no employer withholding on your behalf, tax authorities expect self-employed people to pay estimated tax throughout the year, roughly matching what would have been withheld from a paycheck. Skip that step, and you're not just deferring a payment, you're accumulating an underpayment penalty that compounds the longer it goes unpaid. It's a completely avoidable cost. And avoiding it starts with treating your tax year as 4 checkpoints instead of one deadline. The 4 dates that run your tax year. In the US, estimated taxes are due on a quarterly schedule that doesn't line up neatly with calendar quarters, which is exactly why so many creators miss a date without realizing it. Here's the general shape of the year. Specific dates shift slightly when they land on a weekend or holiday. So always confirm the exact date for the current year. Not in the US. Most countries have an equivalent structure. UK creators know it as payments on account. Australia has paying installments. Canada has quarterly installment payments above a threshold. The dates differ, but the underlying discipline is identical. Pay as you earn, not once a year. The simple set-aside system. You don't need an accounting degree to get this roughly right. The system that works for most solo creators is a flat percentage set aside from every payout, moved into a separate account the moment it lands, before it can get spent on ads, software, or a well-earned treat. A reasonable starting point is 25 to 30% of net revenue after refunds and processing fees, adjusted up if you're in a higher tax bracket or your state has its own income tax, and adjusted down slightly if you have significant deductible business expenses offsetting your profit. Open a separate savings account labeled taxes. Never blend it with operating cash. The day a payout hits, transfer 25 to 30% of that net amount into the tax account automatically. At the end of each quarter, total what's in the account against what you actually owe using last year's return or a quick estimate. Make the estimated payment on or before the due date, even if it's an imperfect estimate. Paying something on time beats paying nothing. Reset and repeat for the next quarter, rather than waiting to true everything up in April. Turning your store.fan payouts into tax math. The good news is you already have the data you need. It's sitting in your sales history. Because store.fan sends money straight to your connected Stripe or PayPal account, rather than holding it in a platform wallet. Every payout is a clean, traceable event tied to specific sales. An ebook here, a coaching call there, a membership renewal on the 15th. At the end of each quarter, add up net revenue across downloads, courses, coaching, webinars, and memberships. Subtract refunds or discount codes issued and apply your set-aside percentage. If Q2 brought in $6,600 net, setting aside 28% means moving roughly $1,850 into your tax account before you touch the rest. This is also where it pays to actually look at your dashboard instead of guessing. Creators who open your store, fan, and let every sale funnel through one connected payment account get a far cleaner paper trail than creators splitting sales across 5 different tools and marketplaces. No reconciling 3 separate exports before you can even start the tax math. If you haven't set one up yet, a live example store shows what a fully built-out storefront with products, memberships, and checkout all in one place actually looks like in practice. What happens if you skip a payment? Missing an estimated payment doesn't erase the obligation. It just adds interest-like penalties on top of it, calculated from the date the payment was due, not the date you eventually pay. The IRS generally won't penalize you if you meet the safe harbor, paying at least 90% of what you owe for the current year, or 100% of what you owed last year, 10% if last year's income was higher. That second option is quietly one of the most useful numbers a growing creator can know. It means even in a breakout quarter where revenue doubles, you can avoid penalties by matching last year's total tax in estimated installments, then squaring up the rest when you file. The penalty for underpaying quarterly taxes isn't a cliff, it's a slow leak. Small at first, but it adds up every day the payment sits unpaid, building the habit so this runs itself. The creators who never get ambushed by tax season aren't smarter about tax law. They've just made the quarterly rhythm automatic. Set 4 recurring calendar reminders a week before each due date, not on the day itself, so there's time to actually make the payment instead of scrambling. Pair every payout notification with the same 2-minute ritual. Check the amount, move your set-aside percentage, done. If your store is on a pro plan, the sales data across products makes this quarterly review even faster, since everything, downloads, courses, coaching, memberships, reports through one dashboard instead of 4 login screens. It's also worth remembering why you're doing any of this in the first place. Because the business is working. Quarterly taxes are a good problem. The kind that shows up once real, recurring revenue starts moving through your store instead of trickling in from scattered invoices and side deals. Creators who haven't yet centralized their sales often lose track of exactly this kind of number, which is one more reason to create your store now rather than mid-growth, when reconstructing a year of scattered payments becomes its own tax season nightmare. Key takeaways. Self-employed creators generally owe estimated taxes 4 times a year, not once. Missing a due date can trigger penalties even if you pay everything by April. A simple 25 to 30% set-aside rule, adjusted for your tax bracket and expenses, is enough to avoid nasty surprises for most solo creators. Your store, fan sales and payout history is exactly the raw data you need to calculate what to set aside each quarter. No separate tracking system required. The safe harbor rule can protect you from underpayment penalties even in a big growth year, if you know the threshold ahead of time. The single highest leverage habit is a recurring calendar reminder tied to a dedicated savings account. Automate the discipline so willpower isn't required. Start your creator store free at store.fan.